Okay, welcome to lesson 7, Bull Flag Surfing Strategy. This is one of my favorite strategies that I trade every single day. In fact, there's almost a trade almost every single day, and it's one of my favorites because it's got one of the highest win rates and it's one of the most profitable strategies which I use. So first of all, let me define it. It's a strategy that seeks to go long on Forex pairs that show a bull flag pattern while surfing the 6 or 18 exponential moving average on a strong uptrend. At the same time, we're going to go short on Forex pairs that form a bull flag pattern, surfing the 6 to 18 EMA on a downtrend, respectively. So a few questions we have would be, number one, what the heck's a bull flag? Number two, what's surfing? So we'll get into that in a short while. So first of all, some of the program stats. I trade this on the 50-minute candles because it gets me in and out within less than an hour usually. I can take anywhere from one trade to even sometimes 3 to 4 trades a day. Profitable on most days, always end up profitable by the end of the month. Okay, now how often does this strategy or this setup occur? Pretty often actually. In fact, almost every day you see it occur easily 5 times on various pairs. But it doesn't mean that I take every single setup. I only take the ones with very high probability. So I usually take about, on average of 1 or 2 a day, sometimes 3 a day. But of course, there are days when I don't see anything that has high probability and I do not take trades on certain days, right? So it doesn't mean that every day you have to take a trade. There are certain days where you look at the market and there's no great setup, you don't take any trades. And on certain days, they all come at the same time and there's so many trades to take. So never chase the trade, let the trade come to you, and only take the high probability ones. So I'll say that on average, you're going to have about 10 to 30 high probability trades a month of this strategy. Okay. Now this works on all Forex pairs, but again, I trade the 8 major pairs and their crosses. So things like your pound USD, Euro USD, dollar franc, dollar yen, dollar CAD, Aussie dollar, pound franc, pound yen, all the different combinations, right? And again, very importantly, we want to use brokers with tight spreads between the bid and ask spread of maximum 1 to 2 spreads. Okay, so this is kind of like what it looks like on the long side when we go long. This is surfing the bull flag on the long side, and this is surfing the bull flag on the short side. So again, I know some of you have questions like, what's a bull flag? What's surfing? Let's get into that right now. Well, first of all, let me define what a bull flag is. In fact, you know what? Even before that, let me talk a bit about what surfing means, right? Now, very often when you look at the currency prices, they look very erratic. They're going all over the place. It goes up, goes down, and sometimes it's really hard to know where the heck it's going, right? But there are certain pockets of time when you see that the price behaves itself, when it's moving in a very predictable manner, and it's kind of like surfing one of the moving averages. And what do I mean by surfing? Take a look at this chart on the left, okay? So you can see that at this point of time, again, it doesn't happen all the time. It happens during pockets of time. So you have to look out for those pockets of time, right? So during this particular time period, you can see that the currency pair was kind of like surfing this red line, okay? Can you see this red line now? That red line, this red line is a 6 exponential moving average. And this blue line is the 18 exponential moving average. Okay. Now, sometimes the price likes to surf on the 6. What do I mean by surf? What I mean by surf is you can see the candles is kind of like finding support at the 6 moving average. Can you see that? Every time it goes to the 6, it kind of like bounces off, bounces off, bounces off, bounces off. Okay. And when I talk about surfing, right? I mean, there are many ways you could surf. It could be sometimes the body of the candle is above the moving average and the lower shadow kind of like touches the moving average, right? And that's fine, that's a surf as well. Sometimes it could be that, again, that happens again. You can see the body is above the moving average and the lower shadow cuts below the moving average. That's a surf as well. Sometimes the price may open below the moving average and close above the moving average, like so. Opens below, closes above. Right? Sometimes it opens above, closes below, and then closes below, opens below, closes above. So this is what we call a very clear surfing yeah, I mean, it surfs the moving average, if you will, all right? You can see, so it's surfing it and it's going up. So you can see that this is an overall uptrend, as you can see. And again, you've learned, how do you define an uptrend? Uptrend is defined as higher highs and higher lows. And you also know that on an uptrend, the smaller moving averages are always above the bigger moving averages. So the 6 above the 18, 18 above the 50, 50 above the 200. So that's a very clear uptrend. Now on the right, you can see a clear downtrend. Okay, so again, on a downtrend, the moving averages are in the opposite sequence. You have got the 50 moving average, which is this blue line over here. You've got the 18 moving average, and you've got the 6 moving average. So it's, again, the biggest moving average to the smallest moving average, that sequence, okay? And making lower highs and lower lows. And over here, you can see that, again, it is surfing on the 6 EMA, right, which is this red line. So you can see it's surfing very nicely. That's called surfing. So it touches it, it goes, touches it, it goes, touches it, it goes, right over here, touches it, it goes. So that's what I mean by surfing. And again, we're looking for those times when it surfs the 6 moving average or it surfs the 18 moving average, okay? So understand surfing right now, okay? Hope you understand that, right? So once you understand the concept of surfing, let's understand what's a bull flag pattern. Okay, first of all, let's look at a bull flag when we're going long, that means on an uptrend, okay? So when we're on an uptrend, we're looking for a long bull flag. And this is what a bull flag is, basically, all right? A bull flag consists of impulse candles and corrective candles. Okay, first of all, what's an impulse? An impulse is a movement in the direction of the trend, okay? So in this case, it's an uptrend. Okay, it's going up. So the impulse candles are the candles that are moving up. Okay, so these are candles in the direction of the trend. And there are a series of candles making higher highs. Okay, so if you take a look at these 3 candles, 1, 2, and 3, these are the impulsive candles. Why? Because they're going up in the direction of the trend, which is the uptrend, okay? And you can see that this high and this high and this high is making higher highs. So we call this the impulsive candles or impulsive wave. Now, why does this happen? This happens because people are buying, all right? So they are buying and pushing the price up, right? They are buying, 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 buying. So you're seeing that impulse is going up. Now, like I said, it can't go up forever. It's got to come back down before it continues going up again. So again, remember that breathing pattern. Breathes out, breathes in, and then breathes out again. So after the series of impulsive candles, we're then looking for the corrective candles. And the corrective candles are candles that are moving opposite in the opposite direction of the trend. So in this case, the trend is going up and the corrective candles are coming down. So it's making lower highs. You can see series of candles making lower highs. So you can see that this high, this high, this high is making lower highs, and lower highs. So this is what we call a bull flag pattern. Why? Well, if you think about this, this is kind of like the flagpole. Right? It's a big flagpole over here. Okay, and this is kind of like the flag. So can you see a flag right now? Okay, that's what we call bull flag. Okay. Now, what is the psychology behind the bull flag? Okay, let me just get rid of all these drawings over here. Okay, so here's the psychology. The psychology is that on an uptrend, all right, we have got the impulsive set of candles, which means the price is going up. Okay, so as it's going up, people are buying, right? They're buying the currency pair. Now, after they buy, what happens is you want to see some profit taking, right? Some people taking profits, so that creates what we call the corrective candles. And what we want to do is we want to enter just at the beginning of the new impulsive wave. Let me repeat that again. We have got an impulsive wave, we have got a corrective wave, and we're going to enter a buy right at the start of the new impulsive wave. Okay? So how do you know the new impulsive wave is starting? The answer is when you see the price making a new high. Making a new high. As you can see, during the corrective candles, it keeps making lower highs. This high, and this high, and this high, right? It's making lower highs and lower highs and lower highs. We're looking for a higher high. So the moment the price goes above the high of one of these candles, in this case, you can see that over here, it makes a new high. We want to enter right at this point here. This is a buy entry, because usually what happens is when a new high is reached, it tells you that the trend is now continuing. Because we are on an uptrend, we are going to go long, okay? Now, what's very important is also we want to enter when the corrective candles are pulling towards the 6 or 18 moving average. Let me say, so which one do I want to look at? Do I want to look at the 6 or the 18? It depends. If it's surfing the 6 moving average, when you see it's surfing the 6, it's touching and going, we want to see that the corrective candles go back to the 6 and we enter at a new high. If it's surfing the 18 moving average, wait for the candles to correct to the 18 moving average, make a new high, and we enter. So you have to see which one is it surfing, the 6 or the 18 moving average. Okay. Now here are a few rules for a bull flag. Okay, one of the rules is that the corrective candles should not break below the surf or the surfing wave, which is below the 6 or 18 moving average. So again, if it's been surfing the 6, it cannot break below the 6. If it's been surfing the 18, it cannot break below the 18. Now it can go below it and come back above it, that's fine. Right? But what I mean is that when you see the entire candle body going below the 6 or the 18, it's no longer surfing it, it's not a valid trade anymore. Okay? Now, the other thing to again understand is that on an uptrend, when we're going long, you have to see the sequence of moving averages. The 6 EMA above the 18 EMA, and that's above the 50 EMA, and it's above the 200 simple moving average. So let's take a look at what it looks like on an actual chart. So over here you can see the actual chart, the screen capture of it, and you can see that at this point of time, it's surfing the 6 or the 18. Take a look. Right? That's right, it's surfing the 6 moving average. And again, if you can't see, this red line is the 6 moving average, this blue is the 18 moving average, this is the 50 moving average, and that's the 200 moving average. Okay, so over here you can see that it's been surfing the 6 moving average, right? Surfing it, right? It's touching, going, touching, going, touching. So it's surfing the 6 moving average. That's pretty clear. Okay, and so we want to see it surf for a while, right? To know that the 6 is a strong support. And then we're going to see the bull flag appearing. So can you see the bull flag? Here's the bull flag, right? So this is the impulsive candles, right? I guess you could take this one and this one as the impulsive candles. And again, how do you know it's the impulsive candles? When you see it going up, making higher highs. So you can see this high and this high, making higher highs. So these are the impulsive candles. Again, these are candles in the direction of the trend, and these are series of candles making higher highs. Now, oftentimes, the impulsive candles are bullish candles. They're green candles. Now, must they be green? Not necessarily. They could also have some red candles inside of them. You could have red candles, but most of the time they are green candles because they're going up. But again, you could have one red candle or two. Okay, so in this case, you can see this impulsive wave going up, and then you've got the corrective candles. And again, the corrective candles are now making a series of lower highs. Okay, so you can see from here you have from this high to this high, so there's higher high, higher high. So impulsive candles. That's your flagpole. Okay, and once you reach that highest high, you start to make lower highs, lower highs, lower highs, lower highs, lower highs. So you're looking for those lower highs, right? So this is your flag. Okay. Now again, your corrective candles are often red. They are bearish candles. But again, must they all be red? No. You could have some green candles inside. Like you can see, this is a green candle, right? So again, we're looking more for the pattern of lower highs than the color of the candle. Okay. Now the question is, when do you get in? All right, now you're waiting to get in the moment you see that one of the highs is breached. That means you see, once you see a candle making a new high, you enter the moment a new high is made. Okay, but you have to wait for the corrective candles to go towards that surfing wave, either the 6 or the 18. So in this case, you can see that it's surfing the 6 moving average. So you want to see the corrective candles going to the 6 moving average. If it doesn't reach the 6 moving average, you do not enter yet. All right. So you can see from here, it makes a new lower high. All right. Now again, it's far from the 6, so we can't enter yet. And again, over here, you can see makes a lower high. Again, it's far from the 6. Lower high. Not yet. Lower high. Okay. Now, the moment you see this candle, you can start to get ready to enter the currency, right? Because you can see that it's now touching the 6, right? It's at the 6. So what I do is once I see this, okay, I'll place my buy order just above the high of this candle over here. Just above the high. A buy stop order. So the moment the price goes above the high of this candle, it triggers my buy order and I'm in the trade. Okay, so I place my buy, I repeat, I place my buy stop order just above the high of this candle. Now you have to look at the spread. If the spread is 1 pip, then you put it 1 pip above. If the spread is 0.5 pips, you put it 0.5 pips above. So depending on the spread, okay, of the bid ask. Okay, so in this case, I repeat, I put my buy order over here. I'm gonna talk about a stop loss in a while, right? So just hang on for a while. So that's my buy stop order. Okay, now what happens? The next candle makes a lower high again. So because of this, does this buy order get triggered? It doesn't get triggered because it only gets triggered if a new high is made, if the price goes above this level, right? So once I see this candle, what do? I will then cancel this order, and now I place a new buy order above the high of this candle. Got it? All right, great. Now, what happens to the next candle over here? The next candle opens here, as you can see, opens here, and it goes up, and it exceeds the high of this candle, and it triggers my buy order. So it triggers the buy order. I'm now in the trade. So that's my buy entry when new high is made. So I buy exactly at this point, and I'm in the trade going up. And it'll hit my profit target somewhere over there. Got it? So that's the concept. So again, remember that for